All right, we're back for Module 12B, talking about stock, initial public offerings, stock options, a variety of topics. Here's our objectives. We're going to look at stock options and how you can use them to attract, keep, and provide incentives to employees. We're going to look at an IPO and why that's important, alternatives to being a public company, and take maybe a little bit of a silly example again, but an example, a straightforward example of, going public. So let's take a look. Now, for this week, I hope you've read Crash Course. All right, that's part of it. That's relevant to this particular, particular module. Interesting example of, a company going, getting in there, venture capital, being on top of the world, and having problems. Matt Johnson. All right, he had the venture capital money and big words, never, the stereotype.com type problem. Okay, let's look first at stock options. Again, they can be used, as I just mentioned, they can be used as an incentive to employees to both attract them, keep them, and make them work very, very hard. Okay, make everybody pitch in because they will be have an opportunity to own a piece of the company, to get rich along with the company, to get rich along with you. All right, so it's a very, very valuable tool to the entrepreneur. Now, some of you, I'm sure, are or looking to be intrapreneurs, if you remember that from the first set of lectures, first week. Intrapreneurs within a big company. Again, big companies use stock options, particularly for intrapreneurial people, managers, specialists, executives that are, doing something, taking the risk, taking the entrepreneurial effort within this big company. So large companies will frequently offer stock options. When I was with Digital Equipment Corporation for many years, stock options were a very, very big thing to me. I mean, they were, I got them quite often as a bonus, as an incentive, pat on the head kind of thing, and made some good money on those options. Well, with a public company, you are typically talking about what they call qualified plans, meaning they're approved by the Internal Revenue Service. And if you are a publicly owned company, okay, either over this, traded on one of the exchanges or over the counter, you want that plan approved by the IRS. And you can be getting price. What you do is what's called a qualified plan. You get a number of shares and you can exercise and sell 10% per year for 10 years. So you have to plan it out. All right? And you don't pay tax until you actually buy the stock. And it can go through a stockbroker, can go through the company. Very, very easy to do. Lots and lots of companies out there doing it. Let's look at an example. In January of 2006, I get an option They give me an option to buy 1,000 shares at $10 per share. So I have the option to buy, at some point in time, 1,000 shares of stock at $10 a share, irrespective of what the price is. Let's assume the current price is 30. Okay. I don't pay any tax on that at this point. In January, a year later, I can exercise, if I want, I can buy 10% or 100 shares at 10. Let's assume that the current price at that point in time is $35. I can exercise that option, which means buy the stock at 10 bucks, and 10 seconds later, actually on the same trade, I can sell it at whatever the current market price is, stock market price is. And again, I said, let's assume $35. So I make taxable income of $2,500. That means I have to pay income tax on it, but hey, it's $2,500 coming in, just like it was, overtime or an extra paycheck or a bonus or something like that. Or if I want, I don't have to exercise it that first year. I can let them accumulate so that in January of 2009, I would have the right to exercise a total of 30%. 100 from January 07, 100 from January 08, and the 100 from January 09 at 10 bucks. And if the current price is 50, I make a lot more money. It's kind of somewhat like a savings plan. Now, of course, I hope you realize that there's a downside on this. If you have options at $10 per share, and the stock price is sitting at $6 per share, I don't think you want to exercise those options. Why should you buy it for 10 and turn around and sell it for 6? Maybe your best choice, if in that scenario, would be to just wait and see if the stock goes back up to where you can make a profit on it. Unfortunately, some of the options I had were at prices that, after the stock market dumped in, I believe, 1987, it never came back to that level. I had options sitting at a price that were just unrealistically high. What were those options worth? Nothing. They weren't worth the paper it was printed on. But you take your chance. Again, hopefully the company grows and the person who has the options, the employee, makes money along with the company. Now, if you're a privately held company, not traded on an exchange or over the counter, you can still have stock options. And frequently with an entrepreneurial venture or new startup particularly, what will happen is the founder, the initial entrepreneur, will want to bring somebody in, and if they're contributing money, you give them a percentage of ownership for money, or you give them a piece of the company for their services. Look, I can't afford to pay you a high salary, but if you come in and do the marketing and sales for my company, I'll make you a 20% owner of the company. I'll give you 20% of the stock. And you know what? If you do a really, really great job, there will be stock options as well. the person may want details up front, like, okay, what kind of options are we talking about for what kind of performance, and those kinds of questions. But that's something you negotiate and work out. It can be done at any price. There are no exercise restrictions. There's none of this 10% per year for 10 years. By the way, in a public company, at the end of 10 years, if you haven't exercised it, the options die. So you have to do it within 10 years. However, the downside is that in a small company, the Internal Revenue Service taxes it at the time of grant. Okay? There's also a question of who's going to buy it, initially. Very often, small companies have restrictions on their stock through buy-sell agreements that we talked about that say you can't sell this stock to just anybody. You have to offer it back to the company first, and then the company will decide. Because again, you don't want just anybody as part owner of your company or business partner. So, there are some restrictions. Here's an example. The equity, our balance sheet looks like this. So our equity is $40K. We have 1,000 at 40. Offer the employee 100 at 10. Now the problem is that if you do that, you've given that person a taxable income, $3,000. They haven't seen any money. They just have options. But they're going to have to pay taxes on $3,000 worth of really unrecognized gain, but it's there. All right. Or you could issue 100 shares at 40, the current book value of the stock, and therefore there's no gain. Or a third choice is you could issue more stock so that, again, Bob, instead of having 1,000 shares at 40, you have, which would equal the $40,000 in equity in the company or owner's capital. Instead, you could make it 10,000 shares at 4, exactly the same, still adds to 40K, and offer the employee 1,000 at 4, so there is no gain. Or you could offer them 1,000 at 3, in which case they would have $1,000 taxable gain. Again, different ways of doing it, advantages and disadvantages. You work it out with the employee in a small company and see what they want to do. You saw this chart before in Module 7A. We're looking now at equity financing, and we did discuss this, all right, in a more general context of looking for venture capital. Again, saw this chart before too. Equity funding, we talked about angel investors and so forth, and now we're going to look at the public offerings piece of this. But again, we're going to focus on equity funding. And again, this chart is from week 7, looking at type of funding, the kind of funding that we would look at, or the kind of company that should look at funding from a public offering. Initial public offering is something that has kind of at the bottom there, a unique business idea, high growth market, niche, and a good, strong team. Here's the definition of going public. Takes a closely held or closed corporation, one that's owned strictly by a small group of investors, owners, entrepreneurs, and transforming it into one where the stock is publicly traded, where the general public can buy and sell stock in the corporation. Again, either through an exchange such as the New York Stock Exchange, NASDAQ, or just over the counter. All right? Doesn't have to be a listed stock. But again, it is available to the general public. Here's the definition of another definition of an IPO. It's the first sale of stock to the public. The text and a couple of texts talk about entrepreneurial firms trade on NASDAQ as opposed to one of the big exchanges, such as the New York Stock Exchange, which is for larger companies. The NASDAQ is heavily weighted towards the biotech, the technology companies. It's an important milestone. You can't go public until you've got a track record, proof that the management team is solid, that, again, you have a good niche, that it's a good market out there. Going public successfully is not easy. All right? And as we'll see in a moment, it can be expensive. But it may be the key to future growth, to becoming a large company, to taking it to the next level, whatever term you want to use, to becoming the next Google, the next Microsoft. That's it. It is an expensive process. You have to go and do a number of things. You need an investment bank behind you, a good PR team. It is, not a cheap and interesting process. It is not a cheap process, nor is it an easy process. There are advantages. You can get a lot of money for growth, expansion, acquisitions, mergers, or just to survive. It is also an excellent way to come up with the value of the company. The value of the company is going to be a function of the number of shares out there and what the general public's willing to pay for those shares. And of course, you can issue more stock as you go along, subject to quite a few regulations and things like that, but you can raise additional money by issuing additional stock. Of course, like everything else, there's a downside as well. Public exposure, the Sarbanes-Oxley Act that I talked about in the legal piece, having to publish your annual reports, all the details given to the Securities Exchange Commission, given to the public, given to your stockholders. You have to be very open about things. Some companies may not want to do that. And we'll see in a moment, part of the supplemental reading related to this module talks about that, about public exposure. There's also a potential loss of control. You could lose the company to a new team. If a venture capital firm comes in or some investors buying on the public, buying publicly traded stock in your company, could buy enough stock to take over the company. All right, we've seen that. If you the read for this week, crash course, that kind of thing. I mentioned in earlier lectures about hostile takeovers. The Pretty Woman scenario with Richard Gere, where he was the takeover artists trying to take over the shipyard. Again, gotta be careful. You are strictly regulated by the SEC, Securities and Exchange Commission, as well as some of the states. There's burdens, reporting burdens that have to be done, and I said it's expensive and an involved process. Okay, so it's not something that you do lightly. You need a high growth rate consistently. Either a strong earnings record or a really hot new idea. Hot new ideas used to be terrific, but people have been burned so many times now that they'd rather see a strong earnings record rather than some hot shot idea. A good track record, a great management team, and lastly, an underwriter, an investment banker, the attorneys, the accountants necessary to pull this thing off. Part of it, what that the underwriter comes out with is a prospectus, all right, for the stock that is being offered to the public. It has to be approved. Registration. You may or may not have heard the term, if you've done any investing, of a red herring. Red herring, as herring as in fish. It refers to a prospectus for a stock that's going public that, and why it's called red is there is a banner printed on the top of it, a warning saying that this security is not yet public, it has not been approved by the Securities and Exchange Commission, and gives all kinds of disclaimers. And it's a very risky. I've been involved in a few of them, mostly unsuccessfully, unfortunately, as an investor. But take a look at it. Again, the text talks at page 570. A little bit about in that. Well, it's in that chapter about this. That page number, I am not definitely sure about. I just looked, but the text does talk about some of the issues of going public. Well, what kind of alternatives do we have? And there are alternatives. Again, I suggest that you look at the supplemental reading for this week called A Little Privacy, Please. More small outfits are deciding that being a public company isn't worth the hassle. And we've seen companies go private, even big ones. Chrysler was a publicly traded company, and the people who bought them out decided to take the company private to avoid the public exposure, give them more flexibility, be able to handle things differently. It's great if you got the money, You can do a private placement. There's a thing, and it's beyond the scope of this course. It's something called a Regulation D, where you can have up to 35 investors. It's called a small company offering registration. The question here, though, is, are the new owners going to be happy with the existing management team? If you get all your funding from a small group of investors, are they going to be happy with you? Whether they're venture capitalists or not, what kind of guarantee are you going to get that's going to still be your company? You can use bank loans. We talked about that back in sources of funds. But remember, bank loans are credit funding, not equity funding. Yeah. And consequently, you have to pay those loans back, or not credit funding, debit funding, meant to say. You have to pay those loans back with interest on debt financing. And you can get credit through, various sources, through your suppliers, your leasing companies. Again, we explored that in sources of capital, different ways of getting those funds. You can go for a private placement. Again, this kind of sounds like the sources of funds lecture. Go back to your family and friends, business angels. But again, we're not talking about loans. Here we're not talking about debt financing. Here we're talking about selling them a piece of the business. But again, maybe you want to look into that. Hard to say. If you decide that you want to take your company public, here is kind of the Bible, all right, for the entrepreneur in that sense. It's a good book. Gives lots and lots of information on taking your company public. All right. All right. Let's take an example. I said we would do a, perhaps trivial example, but let's go through one just so you can see what it looks like. Company called .bomb. All right, we're going to do an IPO, initial public offering. Here's our balance sheet when we started the company. The two of us, Bob and Sam. Okay, Bob and Sam started this company. We've got 40. Again, the balance sheet. Hopefully, you know what a balance sheet is by this point in the course. If you don't, you better go back and revisit some of the financial piece, because it's a very important part of the business plan. Got a cash, equipment, no liabilities, and again, our assets minus our liabilities gives us our equity. So we have $200,000 in equity, corresponding to 1,000 shares of stock for Bob at $100 per share, and 1,000 shares for Sam at $100 a share. Okay, hopefully this is easy to understand at this point in time. I would hope you have no problems. At the end of the first year, we've done some business. We sold some product or services, made some money, bought some more equipment. Okay, so we've got $800K in equipment and some cash. And we've got a loan, maybe some accounts payable, bills we haven't paid. So we got $1,700K in assets, $300K in liabilities. So our equity is $1.4 million. Correct? $1,400K, $1.4 million. Well, Bob has still got his 1,000 shares, and Sam has still got his 1,000 shares of stock. Haven't issued any more stock. No reason to. Not important. But those shares are now worth $700 per share. Make sense? I certainly hope so. Well, we decided we want to go public. So what do? Well, we ought to take a look at the value of those shares. $700 per share of stock is very pricey, because if you remember when I talked about stock, you really can't buy or sell a piece of a share on the open market. Okay, the only way that works is, as dividends. If you're getting a stock dividend as part of the dividend on your or already ownership, the computers can issue 1/1000th of a share, pieces of a share. But generally, you trade whole shares. So $700 per share, kind of limits your flexibility of what your investment can be. So you can either have 1,000 at 700 or 10,000 at 70 or 100,000 at 7. We decided to go with the $7 a share because it keeps the price low, makes it attractive to a lot of people. You can come in and buy 100 shares, 1,000 shares, with a reasonable amount of money. So Bob and Sam figure their IPO, they will each have 100,000 shares, plus they're going to issue an additional 800,000 shares at $7 a share to the public. That means that there will be 1 million shares of stock in the company worth $7 per share. And that should generate $5.6 million for expanding the company. Okay, what happens? Well, if you think about, I didn't prepare a chart. Sometimes I do this on the blackboard, but in face-to-face class. But dollars on the vertical axis and the weeks on the horizontal axis, and you see the stocks start to come out and climb. The line going up from left to right. When the stock comes out on the day of the IPO, it comes out at 7. In week 2, it has progressed to $21 a share. And in week 4, it's sitting at $42 a share. Why? Good publicity, good hype from the press, good marketing on behalf of the company and the underwriter. People are saying, wow, .bomb has got this great product, this great service. They're going to be the next Microsoft. They're going to be the next Google. They are just fantastic. And want to buy it and vie with offers for the price, driving the price up. I want to buy the stock. Okay, I own some stock. I'll sell it to you for $30 a share. You buy it at 30. I may have bought it at 15. I may have bought it at 7. I made some money. You bought it now. You're hoping you're going to make more money. You're hoping the stock's going to go to 100. If you bought it at 42, you'd like to see it at least go to 84. Okay, right after our IPO, here's our balance sheet again. We got a bunch of money in. We've got equipment. Okay, the money that came in is cash from the sale of the stock. This is going to fund our expansion and our growth. Again, the book value of the stock for Bob and Sam is still the same. It's still $7 a share. And we've got 5,600,000 dollars in equity, representing that 800,000 shares that are in the public domain out on the public market at $7 a share. Now, that can include stock held by the company. All right, may not already all of it may not have been sold, but if we've got 6 million too, yeah, we probably sold most of it. Let's look at the balance sheet 4 weeks after the IPO. We've got $20 million. Still got our $800K worth of equipment. We haven't done anything with it yet, more yet. The book value of the stock is the same. Still $7 a share. Hasn't changed. But we've got this thing down a little ways down here, if you can see the cursor, called additional paid-in capital of a little over close to $14 million. That is money representing the stock that the company sold to investors at higher price, at over 7. The company may have had stock. It wasn't all sold initially. It wasn't captured initially by investors. And the company was able to sell it at higher than the $7 a share that it came out. It sold it at $13, $21, $30, maybe even $42 a share. Now, please realize that the only time the company gets money is when it initially sells the stock. If you bought stock on the day of the IPO for $7, the company got $7. If you sold the stock 2 weeks later at 21, that $14 profit is yours. It does not go to the company. All right. Hopefully, you should have, gotten that concept, in a finance course or a principles of management course. Again, the only time the company gets it is when the stock is sold by the company to the first investor. Once it's out there in the marketplace, in the stock market itself, the buying, the profit and loss incurred goes to the investor, not to the company. But okay, let's assume the company sold the stock wisely, didn't put it all out there at once, or didn't hype it up too much so that they were able to capitalize on this additional paid-in capital. Okay, what's Bob and Sam's equity down at the bottom in bold? Book value is still $700K. If we look at the assets, again, we assume we wiped out our liabilities, just keep the examples easy. Based on assets, Bob's worth a little over $2 million. Based on the stock market value, assuming, again, that at week 4, the stock is sitting at $42 a share. Well, Bob owns 100,000 shares at $42. That's $4.2 million. Bob and Sam, who started their business a little over a year ago with a $100,000 investment each, today have parlayed that $100,000 initial money into $4.2 million. They are millionaire. Each of them are millionaires. Says who? Well, basically, it's some reporter on the business news on the television who's saying that. The stock market, is saying that. Do they really have $4.2 million? Well, they've got paper. They've got stock that at this point in time is worth $4.2 mil. But, how realistic is it? Let's assume that Bob and Sam are not doing such a terrific job running this company. They've got a burn rate of $2 million per month. Their spending money and not making money. Okay, kind of like satellite radio. Okay, not profitable yet, at least not at the time of recording this lecture. Let's assume they're burning $2 million per month. They burn through the 20 mil in 10 months. What does our balance sheet look like then? At the end of 10 months after the IPO. We've used up all our cash. We still got our equipment on the books. Is it still worth $800K? I don't know. At a fire sale, maybe not, but at least on the books, it's still there for $800K. What about the equity? Let's assume, again, we have no liabilities at the moment. Bob's still got his 100,000 shares. Sam's got his 100,000 shares. And all the other investors have the other 800,000 shares. Well, again, for that balance sheet to balance, we've got to, come up with the right numbers. So Bob's investment is, or Bob's equity now is 100,000 shares at 80 cents per share. The stock is worth 80 cents as opposed to $7, as opposed to $42. And the investors who bought it at whatever price have also lost money. Bob and Sam, who started their business about 2 years ago now, went from $100,000 to being each worth over $4 million. But then, in a sad turn of events, the business was not successful. And today, their entire net worth, their equity, is $80,000. Easy come, easy go. Well, somebody always asks, could you get out while, the stock is at 42 or 30 or something like that? That's called insider trading. Martha Stewart and those problems, go to jail, do not pass go. Can't really get away with that thing. Once you decide to go public, there are severe restrictions on executives and officers of the company and directors of the company being able to sell or divest themselves of stock, mainly because, again, they have inside information not available to the general public and could take advantage of that. So there are severe limitations. And again, you mess around with that kind of thing, you will go to jail. So, bottom line, going public is not the holy grail. It is, a nice idea. For some companies, it's great. For some companies, it's wonderful. Again, I point you back to the supplemental reading about a little privacy, please, deciding not to go public. You have to decide. But the advantage of going public, of course, is a way to generate money, a lot of money, in a relatively short time. Okay, in our last module, the last module of the course, formal module of the course, 12C, we're going to look at getting out of the business, an exit plan if the business fails, talk a little bit about bankruptcy. It's not a pleasant topic, but it's something you should at least have some knowledge of. And the nice part is something called a harvest plan, where the business is successful and you either want to retire or go do something else, or just not do anything, collect the money. So, again, as I said before, do the supplemental readings and make sure the business plan is almost done. Thank you.